and it's got nothing on it. The Nifty Bank is absolutely flat as well, 0.1%. The 57,200 is where we're at. The small cap index is up a little bit, but it's barely in the green, 0.12. And I think you've got the mid cap index, which is starting up about 10 points as well, but it's absolutely flat there as well. So, yeah, I mean, not very much to go with as far as indices are concerned. 1,100 stocks are higher, 500 stocks are lower. The Nifty heat map up on your screen. So you've got about, 20, 22 names which are lower. Bulk of it, though, is in the red at this point in time. It's actually FMCG. I mean, so Monday you had FMCG index up 1.5%. Lever Asian Paints are the two names which are on the green side, and some tech names are in the red to begin this session. Surbhi.
Okay, 29 points lower at this juncture. The weakness is coming in from a couple of IT names. Wipro is down 1%, Infosys is down 0.5%, Tech Mahindra is also starting lower. HCL Tech is down 1% as well. So IT is getting nervous ahead of the earnings. L&T is seeing about 0.5% shave off. Mahindra & Mahindra is seeing very mild profit booking. Titan, by the way, that was down 6.5% yesterday, is down another 0.25% this morning. Trent is also slightly lower. So that's the losers list. Let's look at the winners. HUL, 1.5% on the upside, up and about. Asian Paints, 0.7% higher. Mangalam was just telling us about some of the broker notes, which are sounding a little more optimistic on the paint sector now, and paint stocks. There's Geo Financial, there's Cipla. By the way, let's pull up some of the pharma names. Cipla is up. Dr. Reddy's is down 0.25. There's no meaningful move on pharma because anyway, I mean, you heard that soundbite from the US president. He was saying we could put 200%, but it's in the future. Want to give the industry some time, etc., etc. So nothing concrete. So pharma seems to be all right for the time being, but it's more down than up. Eternal is also lower. So very clearly, the trends are more, defined on the downside this morning. 30 points lower now. 35 points lower actually on the Nifty now. Mangalam?
Both of you all are sounding like the first 20 minutes of a classical concert where an alap happens, not much in terms of stuff, but there are a lot of nuances under that alap, and that's exactly what is taking place right now. You know, the Nifty, the frontline indices is absolutely flat, marginally lower, but look at the nuance out here. You have the consumer staples doing well. We've been speaking about how Jefferies has gotten positive on, HUL, Asian Paints, as well as Varun Beverages. All these stocks are among the top gainers, not by too much, but gainers nevertheless. We are seeing some traction on, Berger Paints as well. HSBC is written too. But Union Bank, weak update coming in. That stock is down 4.5%, 5% straight off the bat. While a lot of the other pharmaceutical companies are doing well, the domestic ones in particular, the ones that have foreign parentage are not doing very well. So Pfizer, for instance, down about 4% at open itself. And then we have, I'm looking at Sun TV, wondering whether there is a move on that one on the back of an alleged truce between the brothers, the Maran brothers. That stock too has opened about 1% higher. Dish TV, 5% higher. The Z Group stocks have been doing well. Obviously, it's a 5 rupee stock, but Religare is the other one, which is up around 5% as well. The hospitality companies continue to do well. Sami Hotels is one of them, which is up around 2.5%. Then you have Garden Reach Shipbuilders, the usual suspects, the ones which are higher. And on the lower end, we have Phoenix Mills, Godrej Properties, and Dream Folks, which continues to see some traction on the downside. So it's an alap with a lot of nuance in the broader markets. And the movers aren't very big when it comes to volume. So maybe towards the end of the concert, there is some more percussion that comes in.
जिनकी हिंदी थोड़ी तंग है, आप उसको उनके लिए बताइए अलाप का मतलब क्या है?
अलाप
हमें तो पता है, पर आप बताइए.
मुझे खुद भी इंग्लिश में मैं अलाप नहीं समझा सकता because it's a Hindustani music concept. I don't think the foreigners have, got into the greatness of an alap.
Well, let's just hope the market picks up from that alap and moves to a nice crescendo. So to use a English word when it comes to the music world. But yeah, by the way, I think it was a JP Morgan upgrade on a lot of EMS stocks, electronics manufacturers. Sirma is up about 3.5%. Dixon & Keynes also on lackluster morning, managing about 1-2%. So this space is a little buzzing and active today.
Absolutely. We've got 1,400 stocks higher, 800 stocks which are lower at this point in time. Vari Energy, I think it was up yesterday as well on decent-sized volumes yesterday. Yeah, actually, volumes did pick up on Vari yesterday. So Monday it closed at 2,900, yesterday at 3,100. and it's up a little bit, 1.5%. But it's the largest, the number one volume traded gainer on the NSE. So that's the reason I'm mentioning it. And of course, I mean, a name like JP Power, I'm not sure what's happening here, penny name, but JP Power was up 20% on Friday. On Monday. Yesterday, it didn't go anywhere. It's starting 2% higher. That is Jayaprakash Power, JP Power, number 2 volume-led gainer on the NSE. So that's the other one. I think Mangalam already mentioned Sirma, etc. Sirma is up 3%. A name like Religare is coming up, 4% higher on Religare. Again, I mean, the Burmans are in and they're in the driver's seat in Religare, but stock has not really done very much. I've heard from many the downside is limited, but I mean the upsides have been hard to find here for a while. Maybe it'll come, but that's Religare for you. Lal Path Labs is up 2.5%. SW Solar is up about 2.5%. So it's low. It's low in terms of the price action and volumes right out of the gates, at least as you look at things at this point in time. All right, well, let's talk about the markets in some more detail. Karthik Kumar is fund manager at Axis Mutual Fund. He's with us. Karthik, great to have you with us here in the program. Good morning. Thank you for your time. How are things set up, Karthik? I mean, just in terms of the price action, momentum, or the lack of it for the last few days now. What have you been doing, and your thoughts on the market structure itself?
Okay. So actually, if you look at it over the last 6 months, essentially the markets have done fairly well, considering that we've had geopolitical tensions and economic tensions because of tariffs. And in that context, what we saw was market taking umbrage under value as a style, and value did quite well over the last 6 months, whereas traditional momentum growth, these styles kind of took a backseat. However, over the last 2 months, what we've seen is a much more risk-embracing style where high volatility, high beta stocks have done well. Momentum has been the better performer over the last couple of months. And we've also seen that in terms of cap space, where while over the 6 months, small caps and mid caps have lagged, over the last 2 months, we've seen sort of a comeback by small caps and mid caps compared to large caps. So I think there has been a bit more risk appetite that we've seen over the last couple of months. And that was because of certain policy certainty, that was because of a pro-growth stance both by the central government and by the Reserve Bank in terms of taking proactive steps. And all those things, I think, kind of helped the risk appetite over the last couple of months.
Okay. All right, got that. Thanks for joining in, Karthik. Good to have you on. So investors are really wondering what next, because now we're within striking distance of the all-time highs. And, one is looking for further ammunition. So which are the sectors where you think growth could come through? Because there is no better fuel for a bull market than actual earnings growth. What are you most optimistic on?
So I think the growth sentiment across industries and across sectors should improve going forward for a couple of reasons. First, in terms of we've got a favorable base where last year was elections, so the activity was on the muted side. Plus, we've got actions by RBI that essentially have ensured that interest rates are lower, liquidity is higher, plus the tax relief that kind of kicks in. That's from a macroeconomic standpoint. And also, if you look at it purely from an earnings standpoint, we front-loaded a lot of the earnings cuts for FY26 over the last 3 months. And which is why I think going forward, and the extent of earnings cuts have been intensity of earning cuts have been quite significant over the last 3 months. And I don't expect that to persist. So I expect earnings environment to progressively improve over the subsequent quarters, and which I think will prompt the market to kind of look at good return opportunities in the near term.
All right. Where do you stand on the entire consumption, space conversation here, Karthik? Are you betting the discretionaries which are likely to outperform when the stocks are highly valued, or are you looking at some recovery in the staples where the stocks have seen a lot of time correction and maybe things are improving for the better? Where do you stand on that?
So we still we still like specific themes within consumer discretionary, especially with related to hospitality, travel, tourism. But in terms of traditional FMCG, we are yet to see an uptick in the underlying data. The earnings previews that have come in so far kind of reiterate that point, where we've still not seen an uptick both in the rural and the urban side. Commentary is getting better depending on which company you're speaking to, but largely we are yet to see it in terms of earnings upgrades as well. So for now, we'll still stick to our conventional themes, but at some point, the consumers, the traditional consumers, will also become attractive once we see an uptick in earnings estimates.
Yeah, no, absolutely. Makes sense. You know, we were just having this discussion with Digant earlier on, and he said, well, NBFCs is one area which is perhaps a space in financials which offers opportunity. I mean, would you kind of agree with that, Karthik? I mean, and what kind of positions do you have? What segments really, broadly?
We are positive on financials, partly because of the fact that we are still seeing a mid-cycle kind of valuations there, and the fundamentals for the sector are turning positive for the reasons I already elaborated on. And within financials, we like both the private banking space, and we like NBFCs. We like both categories, so we have a reasonable exposure across that spectrum.
Okay. Karthik, on the manufacturing side, manufacturing, Make in India, because there's such huge shift going on, right, between the whole realignment of global supply chains as well. Specifically, are there any verticals that you would be optimistic on?
We remain, while the whole policy action in the West and the ramifications still need to be watched out, but we need to watch out for. But in the near term, we remain positive on power, T&D. Those are the areas that we are kind of bullish on.
Okay, power and
space.
Power and T&D. Okay, utilities. Part of that category?
Somewhat, but more T&D place, I would say.
And valuations are comfortable?
Valuations are reasonable. I would say we all know our market itself valuation is at the higher end of the spectrum. So, which is why I would argue over the next 3-4 months till we see an uptick in earnings, the market is likely to be range bound. So I think that applies across sectors as well, largely.
In the auto space, is there something that you like? Are you looking to play this? Because, the per capita auto is still the lowest in the country from a macro standpoint. But a micro standpoint, the largest player has been losing market share because SUVs and, bigger cars are seeing more sales than entry-level cars. Then you have the two-wheelers. Then there are the auto ancillaries. Then there is the one which is exposed to global markets. So there is uncertainty there. How do you play this?
So with autos, we've kind of trimmed our exposure through time. We have selective exposure to autos through some that have exposure to the segments that you talked about, which are largely the beneficiaries within the four-wheeler space. So we do have selective exposures both in the four-wheeler and two-wheeler space within autos. But overall, we've trimmed our exposure through time because if you look at the sales trends, if you look at earnings trends, expectation trends, all have moderated, and valuations have kind of are full as well. So we've kind of trimmed that exposure and are more selective about it in that space.
Okay. All right, Karthik, good conversation this morning. Thank you very much for joining in and giving us your perspective on the market. The market's actually okay, 40 points lower on the Nifty, but one stock is definitely catching my eye at least, and that's BSE. BSE has made a sharp move from its very flat opening. So now the stock's about 60 rupees higher. And it seems to be trying to recover some of its loss yesterday. It was down very sharply yesterday as well. Well, speaking of BSE, let's talk about what lies ahead for whether it's exchanges, whether it's market participants, and of course investors themselves. We're talking about all the ongoings in the futures and options market. Retail investors in India lost over 1 lakh crore rupees in the derivatives market in FY25, and about 91% of these individual traders lost money in FNO. This is according to, of course, the latest study released by market regulator SEBI. Let's discuss this and the way forward with Gaurav Seth, Managing Director and CEO at 5 Paisa Capital, and Ashish Rathi, Whole-Time Director at HDFC Securities. Ashish and Gaurav, thank you very much for joining in. There's just so much going on in the futures and options market. The last 1 year, we've seen the regulator tighten a lot of the screws. We've had the whole drama play out in terms of expiries, now reducing the products to 1 per exchange. And this morning, there are reports suggesting, I think the Mint put out a report, that maybe they'll look at, instead of a weekly expiry, now a fortnightly expiry, if they're not satisfied with the reduction in just the sheer amount of speculation. Your thoughts on, first of all, whether the F&O market needs further tightening? Ashish, let's open with you.
So in terms of tightening, you will see a lot of measures have been taken already by SEBI. I think so there's an October 1 circular wherein 5-6 measures have been taken, which came into effect mostly in the last quarter of last year. But yes, in terms of tightening, so the major concern is on the retail side. So one kind of tightening which we can look at is a product suitability test. Depending on the risk appetite of the customer, maybe he is allowed to take positions in derivatives. I think so that is where we will reach a situation wherein, okay, you have the risk appetite, then you are allowed to take that risk and you understand the risk better. I think so that would be a good thing that which SEBI can look upon it. In terms of structural measures, a lot of things have already gone about, making from 5 expiries to 2 expiries, then increasing the margining, upfront collection of option premium, plus all these market-wide limits. A lot of measures are already in place or still in the process of implementation. So we can wait and see for some which are still in the process of implementation, what is the impact. But yes, in terms of retail investors, product suitability test is something which SEBI can look at introducing.
Ashish, this is a very interesting, just Ashish, allow me to come in over here. This is an interesting concept you're bringing in. I don't know, does it exist in any other major market worldwide? And then the onus will be on whom? Maybe SEBI can design a test. How do you design it? How do you decide if, F&O trading is suited for me or not? And maybe it is for Prashant, maybe not for me. Anyway, we don't trade them, and that's aside because of our regulations, internal regulations. None of us actually trade in the market. But how do you decide it? Will the onus be on the broker? Can it really be a feasible solution?
Yes, it can be a feasible solution. So you take the inputs from the customer, depending on your net worth and everything. Then you take the risk suitability. Okay, so how much is the risk you can bear? Basis your risk appetite, you may be quantified as a high risk. You are ready to take high risk with. And basis that, and depending on your net worth and everything, you will be allowed exposure in derivatives. So that can be worked out. Maybe in stages, at an initial stage at a lesser level, at a later stage, maybe at a higher level. So these things can actually, then what happens is the customer himself is declaring, yes, I'm ready to take riskier bets. And then even if he make losses, the understanding is that he has understood it much better.
All right. That's an interesting point that you're bringing to the table. Let's see whether that gets implemented or not. But let's, bring in Gaurav in the conversation as well and to see how things have changed. Gaurav, there was a serious amount of trading and speculation in F&O that was taking place. And a large part of that, whether it gets attributed to, the underlying equity cult or not, definitely gets attributed to the surge in discount brokers and access to market by itself. Could you give us a sense of what proportion of your volumes right now, traded volumes on 5 Paisa, come in from F&O? How has that number changed over the last few months ever since tightening has come in from the regulators? And once there is a higher tightening, which is on the cards right now, as discussed by a lot of people, will that impact your business a lot more with options traders looking to come down from here on?
So look, I think I just go back to your earlier question. I think this is definitely a wake-up call, but also in terms of, I see this study coming from SEBI, which was published recently as a follow-up to what was done last year, right? A lot of the tightening and a lot of the structural reforms that the regulator wanted to put in place were already put in place. And of course, that did have an impact, not just on us, but across the industry, and which is a fact to see, right? So the volumes were impacted temporarily. So if you look at, volumes compared to last year, we are lower, and a lot of our peers are lower. But if you look at it from the last 2 years perspective, it's actually higher. So while I think discount broking and platforms like us have played a great role in bringing access to the market, I think what needs to be spelled out here is that whether it is FNO or whether it is any other kind of product, right? I think the mandate of actually figuring out whether this is right for me or not, which I think even Ashish was talking about earlier, instead of pushing it to the brokers, it should also be in terms of, how am I educating the customers? What is it that we are doing as platformers, as brokers, to upskill some of the people who are coming into the market, so that they can figure out for themselves. So in any case, after last year, so the moment you log into a platform, every single time, you have an acknowledgement that is done by retail investors, any investors, right? Those 6-7 points which are whether FNO 9 out of 10 people lose money and so on and so forth, right? I don't know how much impact does have on people, right? I think over a period of time, it is for you to self-realize that, right, is this working for you? What is the level of skill you have? What do you need to do, etc. And I think we as brokers and as platforms have to play a major role in that.
No, well put. Gaurav and Ashish, morning. Prashant here. One thing is clear, and then of course, all of this we're talking in the backdrop of that Jain saga, right? Which has happened, and it's kind of still, in a way, amazes me that many are still talking about whether this was. Of course, I mean it'll have to be proved in court, but the simple point that a normal player in the market would try to buy or sell with minimum impact in the price, right? But if the business model itself is to impact the price, I mean, I think that is where that SEBI order sort of comes in from. Let's just Gaurav talk about what else can happen. There are reports this morning, for example, that this is not one and done in that sense. On the option side, the regulator wants to. And we have that report also which shows how many people have lost money. So there is perhaps more action coming in that sense. One proposal perhaps is the regulator may revise the weekly contract expiry schedule. So from the current weekly, they may go to fortnightly. Gaurav, any thoughts on this?
Well, I would not like to comment on what the regulator is thinking. I think they probably know better than us, and in terms of like what are some of the decisions they want to take for overall market stability. However, I would like to make a point is that again, it really boils down to people figuring out for themselves, where they are in the spectrum, right? If you look at, and I actually, to be honest, I have not read every single page of the report, but I was glancing through it and went through this 33-page report. Where there is a statistic which shows certain correlation to how much money you are making based on what your income level is, right? As an example, declared income now on paper, and what that shows is, while you can't say that people with high income are necessarily better traders or people with low income are necessarily inferior traders, but the fact is how much how much thought you are putting into what you are doing. And actually be clear about where you are in the spectrum, what you need to do to get to become a profitable trader, and so on and so forth. I think once that culture comes in, where people sort of self-analyze over, I mean, there is enough data out there. There's no dearth of data. Like anyone interested in figuring out.
No, Gaurav, you've done this a long time as well. This is, if reports, I mean, and this is, I'm not saying this is not necessary, absolutely necessary, but it's at the end of the day, it's an addiction. I can put it bluntly. You lose money, you make money, you can't step away. And I think we all kind of recognize that. So that is the reason why I'm saying, I mean, as some of the news reports suggest, they perhaps may look at additional measures. Awareness, self-realization, etc., as both of you said, is one thing.
That we need to have for a lot of things in life.
For a lot of things in life.
But we may not.
But it doesn't happen.
So you need regulation.
So, Gaurav, again, my point is, you said, yes, it is for them to decide, but you think, the cost-benefit in that sense. Some would say, what about liquidity in markets, depth of markets? Others would say, perhaps, this is more important. So that's what my question was, Gaurav. Gaurav?
Yes, sorry, could you repeat?
No, my question was with regards to going from weekly to fortnightly, the argument, the cost benefit in that sense. How do you look at that? If this were to happen, of course, the regulator knows best, as you began by saying, but what is your view?
So my view is that obviously it may have some impact on the volumes in the short run. But as we've seen, if the data is to anything to go by for the last 1 year, volumes start to return to normal in the course of time. I mean, if you're asking me a specific point, what my personal opinion is, whether it is going to be weekly to fortnightly, yes, it could have an impact. Definitely, it could have an impact on the volumes in this segment.
Sure. And, gentlemen, what we've been discussing is so far the regulator taking all of these tightening measures to curb what it feels is perhaps excessive speculation leading to retail losses. And that is a separate debate. I mean, whether the regulator should have a moral view on this or not. But what my next question is that post the Jane Street episode, does this get another layer altogether? I mean, would we perhaps see tighter regulation or a change in some F&O frameworks to avoid what the regulator feels was market manipulation and abuse? And would you say, and I mean, I know this is going to play out over the next couple of days, but to say that Jane profited off retail traders and investors, would you completely agree with that? Because that adds a whole new layer of why we need tighter regulation, if that were to hold true in the courts of law. So quick thoughts on this from both of you. Ashish?
So in terms of, probably the episode in hand of Jane Street, they had accessibility to maybe you can say sophisticated instruments with which they did trading. Okay. So right now, if you look at whatever algo framework they could do, it's in the form of HFT, they had sophisticated instrument. And whereas retail currently, as things stand by, obviously effective August 1, they will have accessibility to algo trading and everything. However, that created some kind of an advantage to them. Plus, obviously, their appetite to have large money. Now, that is a structural advantage that they have and they will continue to have. Let's understand that. But however, in terms of regulatory measures, definitely the view is that we may see some measures in terms of some of the sophisticated traders benefiting out of retail investors. That's the understanding which everyone is getting. So we may see some measures. Now, whether these measures are structural measures in terms of making the changes to expiry, reducing the number of expiries, all things, or whether it comes by way of what I said is product suitability test at the retail investor. That needs to be seen. But yes, definitely what I think so after this episode, there could be some structural changes in the derivative. But as Gaurav rightly pointed out, so whatever structural changes are there, in the short term, you may see a blip in volume, but in the long run, again, that it comes down to the same level. See, finally, it is up to people to decide, retailers, while they make losses, but as long as they know the risk about it, then it should be okay.
Not true. So just very quickly, Gaurav, same question to you. Because of the Jane episode, would you expect any more new stringent measures? And if yes, what kind?
Look, I don't want to speculate here, but I think just logically thinking, you could potentially expect some measures. What they would be, I mean, I'm in no position to comment. But again, I mean, if you look at the data, especially if you're looking at the report, like a lot of, I mean, it is very clear that a lot of the FPIs and the more sophisticated traders on the other side, as a proportion, made higher percentage of profits versus compared to a normal retail trader, right? So again, comes back to the same questions: the level of sophistication, your level of skill, and so on and so forth. So if you have to be in this market for a longer time, what is it that the retail traders do? And especially being a retail platform, I think that's the lens that at least we bring to the table in terms of thinking that, like, how do we do what is necessary for our customers. But what the regulator will do, we will see in the next couple of days or next couple of weeks.
All right, gentlemen, thank you so much for joining in and giving us this view. Obviously, it's at the end of the day up to those who are participating in this to know what their risk appetite is out here. In that, I would, believe that players like you would also, be responsible in informing the clients about what their risk appetite is and the product that you're offering, the risk nature of that product, along with what the regulators are doing to curb this speculation and ensure that everyone participates in this in a fairly equitable and knowledgeable manner, knowing very well what the underlying risk of what this offering is. Gaurav, Ashish, thank you so much for joining in. we'll invite you once again where we have more clarity on what the regulations are post this as well. Let's move on to another conversation then. We have Signature Global on our radar. The company has reported a steady first quarter business update. Sales and volume have declined year on year, but risen sequentially, while realizations have improved by about 33%. Let's discuss the business momentum and growth outlook. Rajat Kathuria, who is the CEO, joins in now. Quarter on quarter, there's been a big jump, 63% to be precise, but year on year, it's down 15%. Even the area which has been sold is lower, both year on year as well as quarter on quarter. You did have some sales from premium projects. This decline year on year, is it largely because of base effect? Or do you think that there is something underlying which has shifted a little bit in the real estate space?
No, you're right with the former understanding that it's largely because of the base effect. So last year, while we achieved about 10,300 crores of sales, the first quarter was the best quarter in terms of pre-sales for us, where we did about 3,100 odd crores. So we were competing against, the best performing quarter of the previous year. But in general, I think we had a fairly steady show, the last 3 months. We recently, just in the month of June, launched our first, new project for the year by the name of Cloverdale. This is in Sector 71, Gurugram, which is on the southern peripheral road and one of the key micro markets for us. And within a span of less than a month, we've seen a fairly robust sort of response to it. And we are, quite happy, and it's a good validation that these new launches are seeing a good uptake in the market. So from our perspective, it's a good sort of quarter where we've achieved more than 20% of the annual target.
Last year, the entire year was front-loaded with a lot of sales in the first quarter, like you pointed out. This year, you expect it to be more back-ended because you've given us a target of 12,500 crores for the year. And the first quarter, you've done just about 2,500 crores. So the remainder of this year has to be, doing almost 3,300 crores per quarter for you to meet that guidance. So wanted to know whether that is happening. And secondly, on collections as well. While your sales have seen a decline, even the collections are lower by about 26%. You stand by your 6,000 crore collection targets for this year?
So on both the aspects, this year we have a sustained set of launches. So the best case scenario even for us is that there's not a lumpy quarter which we see during this year, and sales happen through the course of the balance 3 quarters. And that's our anticipation because there are quite a few planned launches. Like within this quarter, we are doing 1 or 2 large launches on the Dwarka Expressway micro market. As far as collections are concerned, this is in line with budgets. In terms of collections, we'll see a good spike towards end of Q2 and Q3 because some milestones of a few large projects are getting achieved around that time, and hence collections will not be as equally distributed through the year. But around Q3, we anticipate it to be a fairly good quarter in terms of collections. So the number is in line with budgets, business as usual, new projects seeing good uptake, new business development happening, and collections in line with budgets.
Are you sure about this being business as usual? And I ask this largely because from anecdotal evidence that we have and a lot of chatter that we get on social media, I'm not sure how credible that is, which is why the question to you speaks about affordability issues, especially in the region that you're operating in. A lot of them also speaking about something as direct as artificial inflation of prices and creating this sort of mirage that these houses are selling off like hotcakes because they're selling it to agents, etc. Just wanted to understand what your assessment of the situation in NCR is right now. Are prices anywhere closer to bubble territory? Is underlying demand under pressure?
Prices have spiked over the last 2 to 3 years, and that's why this conversation comes up very often, even on one-on-one basis. But if you really look at the prices over the span of last decade, you will not see them really spiking beyond a particular limit. Our per square foot realizations up just because we've launched a project which is at the most premium location of ours, and that's why you've seen a spike. Over the course of the year, this number per square foot realization is about to go down. So I don't think on an average prices are going up beyond 7 to 8% in any of these micro markets. So, this per square foot realization will come down. Now, with the kind of land prices and with the kind of commodity prices and the kind of product being offered, I don't think, price of, let's say, 13 to 14,000 rupees per square foot basis is something which is, obscenely priced or absolutely unaffordable. I think any given market across the country, these are the baseline sort of numbers which exist as of today.
Okay. Rajat, let's also talk about your overall expansion that you're doing and what that will mean for the balance sheet. Because in the past, you've told us that you plan on becoming net debt-free by FY27. So just run us through, the cash flow position, how you'll be reducing this debt as you go ahead with the expansions.
So see, the net debt position is still almost static. We are at less than 900 odd crores, about 880 odd crores of net debt. 890 crores of net debt exists on the books at the end of this quarter. So that number per se doesn't seem very high to us. And in general, we are not like, we were never rather very highly leveraged. I would say that, as collections pick up, it's in normal course, this net debt number will come down. So there is nothing additional or very special effort which needs to be, made in terms of reducing this net debt. I would also like to add on that most of the land position which we have, in all of these key micro markets, which is, let's say, between recently launched and yet to be launched projects in close vicinity of 40 million square foot and, upwards of 55 or 1,000 crores of, GDV value. This land is mostly owned by the company with less than 5% belonging to, the landowners with whom we may have done collaboration shares. And it is paid for. So see, there is no, sort of hidden or, liability which is there. So there is net debt, which is 890 crores. There is nothing particularly due on the land side. So the land ownership belongs to us, so as this converts into sales and collections, it's all going to trickle down to cash for the company. And hence we feel very comfortable, not just bringing down net debt, but even the gross debt number, significantly over the coming 2 to 3 years.
All right. Nuama says that you'll be net debt free by FY27, so wonder whether that's doable or not. But, on the launch pipeline itself, you said that it is sustainable, you have this timeline. Could you give us a sense on a quarterly basis, what exactly does this mean in terms of GDV being launched in this year, and what do you have in the pipeline for the next one?
So see, for the year, we've taken a target of about 17,000 crores of launches. In the first quarter, we've launched about 1.7 million, which is close to 3,500 odd crores. Again, reiterating that, let's say the launch we've done, the land is fully owned by us. And hence, it's not just a sale, which is getting created. It's going to create cash, net cash for the company. Likewise, in the coming quarter, there is almost close to, you could say, between 3.5 and 4 million square foot getting launched. So again, quarter two is a big quarter in terms of launches. And, likewise, Q3 and Q4 also will see, more launches. So this balance, 13 to 14,000 crores of launches, we are comfortable because we are at very advanced stages of approvals across these projects. And hence, we don't see any possible slippage in terms of the launch pipeline.
Okay. All right. By the way, guys, 10 days back, the PM Awas Yojana, which was meant to boost affordable housing, completed 10 years. This is 25th of June. And of course, the contrast can't be starker.
Yes.
Luxury has done phenomenally well. Affordable, nothing at all. Actually, lenders have told us that there is not enough supply to fund on the affordable side. And I think Signature has told us that earlier as well. Thank you very much for joining us as always. Appreciate you coming on and thanks indeed. We'll take a quick commercial break here. We're going to come back with Biswajit Dhar of Center for WTO Studies and Anup Vadhavan, a former Commerce Secretary. We're going to talk about the Trump tariff letters, the possibility of India-US trade deal. We're at the deadline, so will we hear something tonight? That's the big expectation. Stay tuned. Come back. The market, of course, is doing what it is doing, which is not very much, about 1/3% lower on the Nifty Bank for now. But this is a CNBC-TV18 exclusive. GAIL pipeline tariffs may see an increase of near 20%. Sudarshan is here with details on this. So take it away.
So what we understand through sources that GAIL pipeline tariff, which is expected to come in a month or two, and that tariff revision for its pipeline, there are 10 pipelines for which tariff can be revised higher by 20%. So currently tariff for GAIL pipeline stands at rupees 58.59 per MMBTU, and that can be increased to rupees 70 per MMBTU or higher than that. So if you calculate from 58.59, that increase comes to around 20%. Now, why this is positive for GAIL? Because most of the brokerages in their estimates have factored in the range of 10 to 15%. For an example, Investec is saying it's hoping for a 20% increase, but conservatively, it has modeled a 10% hike in FY26. Jeffrey says it expects 10% increase in GAIL tariff, and if there is a 10% increase in GAIL's tariff, fair value for GAIL as per Jeffries comes around rupees 235, and if there is an increase by 20% in its tariff, then fair value comes around rupees 250. And GAIL management had earlier spoken to CNBC-TV18. It had said that it had submitted for increase to around rupees 78. But if PNGRB, that is the oil and gas regulator, approves an increase of up to rupees 70 or to 71, that will be taken positively. Yesterday, PNGRB member A.K. Tiwari had spoken to CNBC-TV18. Let's listen to what exactly he had to say on the tariff.
I'd like to say one thing, that system use gas is one of the important component, important OPEX for them, for which we have already brought the regulation here. How to reduce the cost of system use gas, wherein we have given that they have to plan 75% of their estimated quantity which they are going to consume. They have to plan domestically or international market long-term basis for 3 years. They have to allocate whatever the least cost is there in their kitty for the system use gas, so that the cost will be reduced. So all these factors are being analyzed, and we are going to take view on that, and we are going to conclude the tariff order very soon.
Okay, well, that's, the gas story. GAIL, positive for GAIL, because as Sud pointed out, expectations were 10-15%. We're talking about 20%, nearly 20%. Stocks, for now, right there at down about 2% or so. Let's talk about tariffs now. And the big question is, with the deadline here, will actually we see that mini deal between India and the US, perhaps tonight. Biswajit Dhar, professor and head of the Center for WTO Studies, is with us, and so is Anup Vadhavan, former Commerce Secretary, who's with us. Gentlemen, great to have both of you here. Thank you very much for joining us. Mr. Vadhavan, chitti milegi ki deal milegi is the question, if I can put it in. But what's your sense, sir? Where are we at?
That's a million-dollar question.
Yeah.
So certainly, it seems from the reports one has been seeing in the press that some agreement has been worked out at the official level. It's lying on the president's table, so to say. And the reactions which have come since then seem positive. There is continued talk from the US president that a deal with India is forthcoming. So that's a good sign. And maybe there is some adjustment in that agreement that would be required, which might be worked out at the official level. So my sort of sense from whatever information is in the public domain is that things look positive, and broadly around the agreement that has been worked out at the official level, some, final initial agreement, it's called an early harvest, will be worked out. So I'm quite, positive based on what one has seen. Although, there's certain concerns, even where the US has entered into agreements, whether it's UK or China, now Vietnam, those are, not very balanced. And the US interests, of course, have been taken care of, but it is debatable whether UK got what it wanted out of it or Vietnam has got what it wanted out of it. So I think it will be important to see the content of the deal. But what I understand is that Indian sensitivities on agriculture, dairy have been addressed, but then our ambitions should have been adequately addressed also. We have certain ambitions in labor-intensive products and things like that.
And we'll see.
And at the end of the deal, we'll still be facing duties on steel and aluminium, which are across the board and now amounting to 50%. Of course, I think for the UK, they have been taken off. It will be interesting to see as to what India gets out of it. Our labor-intensive interests and
we'll certainly, absolutely. And the other question is, what does this deal, in a way, not just with what we will see, but I mean other deals, as you pointed out as well, right? The China deal, for example, there was that handshake over that weekend, but then after that, nothing, silence. Same thing with Vietnam. I mean, trade deals are not two-page documents, right? Which you announce and then that's it. So we'll have to see. But yesterday, for example, Japan, for example, got a letter. Their tariffs were bumped up from 24% to 25%. And I think both the US and Japanese representatives are on record to say that they're going to be intensifying their talks into that 1st of August deadline. So that is the other thing. Even if you get, are given an offer, this is still time for negotiations in that sense. Mr. Dhar, your first thoughts, sir? What is likely?
No, I also think that, there could be some kind of early harvest. And, there are a lot of low-hanging fruits that can be plucked at this point. I would say that, as long as India's sensitivities and Mr. Vadhavan was mentioning about some of these sensitivities, these are taken care of, then I think it will be possible for us to move forward. But then there is, yesterday's announcements that President Trump is going to impose 200% tariffs on pharmaceuticals. Now that's a problem area because, our pharma industry has a large footprint in the US market. The generic industry has a large footprint. And that could get affected. So I think, this copper and aluminum, copper and pharma tariffs, which have been, the speculations are that they are going to be imposed. These would be a kind of, a kind of a dampener. But I still think that there can be some possibility of an early harvest, some low-hanging fruits, as long as agriculture, dairy can be left out of the deal. It's possible to, do something right away.
Yeah, absolutely. But the thing is that, that pharma tariff that he's speaking of, 200%, it's a year down the line, and let's see, too much changes here within 24 hours. So 365 days is a very long period. Let's see what actually eventually comes out of it. But gentlemen, I just wanted to get your thoughts on, what we could be realistically looking at in terms of this mini deal or this interim deal, if it were to come through. So Mr. Vadhavan, what could be India's best case? That the prevailing 10% tariffs continue? And that would not have seemed so bad if it was not for this new BRICS threat. Now he's saying 10% additional tariff on BRICS. So that could mean, speaking today, so we are on 10% tariff, so 10 plus 10, 20 straight away. What India was originally handed out on 2nd April was 26%. So what would be your best guesstimate in terms of what could be a realistic interim, near-term mini deal, so to speak?
Yes, it seems that 10% is going to be the new default kind of MFN tariff which everyone will face. So I suppose if that becomes the case, then India will face 10% on most items, and things which are included in the deal. Hopefully, they'll be at a lower rate. So it's all very confusing. And, as was just mentioned, these letters also which are coming, they're open for negotiation because they are not going into effect immediately. There's a 1 month, kind of deadline, 1st August. So scope for negotiation remains. And the other thing we need to see is that the US cannot, sustain as an economy such high tariff barriers. It'll elevate costs in the US economy. It'll undermine US industry. It'll undermine the competitiveness of US businesses. So the end game cannot be that there is 10% duty on every product at a default level. So I'm a bit confused as to where this is going. It is certainly this 25% and 40% which is being imposed certainly is not the end game, because there is a notice period and it's open for negotiation, and it will be, even the other day when there was some of these duties were announced, the stock market didn't take it well. So the end game is not going to be 10% across the board. So in a, I think, somewhat confused manner and somewhat random, ununderstandable, ad hoc manner, it will go ultimately to a outcome where duty levels have to be sustainable and reasonable for the US economy to function efficiently and competitively. So let's see. It's open for conjecture as to this mini deal. Are we going to get zero tariffs on the labor-intensive products? As is the normal practice in a trade deal. Trade deal is always 0 for 0. It is not 20 for 0, that you impose 20 and I give you 0. So let's see what it throws up. But the way it is going at this interim stage, I won't be surprised if there are some elements like that in our initial agreement also. But then it's all conjecture. One can't make a very reasonable guess as to what it is going to be like. But ultimately, it is in India's interest that we do get 0 for 0 on all the items which are included in the deal. And of course, some areas are sensitive to the extent India allows little bit of access on agriculture. Then that has to be with protections. It can't be zero duty. There has to be some tariff rate quota. So safeguards like that. So I won't really conjecture, but all these possibilities, seem open. Let's see what happens, when it's announced.
I hope both of you will join us, later today if we do hear something in terms of the actual stuff, and then we won't have to, do so much in terms of conjecture, but we'll have the details then, hopefully. Thank you very much, Mr. Vadavan, Mr. Dhar, for joining us. Great conversation as always, and some perspective for our viewers. We take a break. Manisha is with us on the other side. Commodities in focus. Okay, welcome back. The market's not really doing very much, and you've got 4-point change. That's it, 25,530. Let's shift focus to what's happening on the commodities side. And there were some moves. Oil's at 70. There was that big move as far as copper is concerned. Manisha standing by with what is top of her mind. Manisha, good morning.
Morning, and thank you for that, Prashant. Well, I'm absolutely looking at copper because overnight markets, that was one thing that was buzzing, and how. The US copper futures settled nearly 10% on the higher side in the overnight markets. But there was at one point when that cabinet meeting was still on and the US president was still talking, that you saw the copper prices run up by almost 17% to hit an all-time high at around $5.9 per pound. This comes in after the US president has said that he's proposing 50% on copper. This is being aligned with existing 50% on steel and aluminum as well at this point in time. Well, the US had launched probe on copper imports in the month of February, and the reports do suggest that the final decision on this is expected by the month of November. But whether or not an announcement can be done before is something that the street really seems to be guesstimating at this point in time. Apart from that, it also has to do with the US importing nearly 50% of its copper requirements. Much of that comes in from Canada, from Mexico, and major part of that comes in from Chile as well. And there are supply concerns for many of these countries at this point in time. If you look at the import numbers, well, higher imports are expected in US ahead of the tariff implementation. As of now, this is an announcement of a proposal. The implementation date is yet to be decided, but before that, you will see a lot of copper being imported into US. The US to LME premium currently stands at a record $250 a ton. So that's a very high number onto that side there. Also, when you look at the overall markets, well, we have seen those gain up as well. And that arbitrage or disparity is quite clear to see. The US copper prices in the first half of this year gained up by 26%, while the LME copper prices gained up by 12%. So we are looking at US copper prices trading at a strong premium than what the copper seems to be doing in other two exchanges globally, that is in London and in Shanghai as well. Apart from this as well, there is various supportive factors. A very, very bullish report coming in from Goldman Sachs says that China in 2025 will see copper demand rise up by 6%. A PwC report says that 32% of global semiconductors production could face issues by 2035 with the kind of supply concerns and disruptions that we are seeing in case of copper. Also, there have been reports of roadblocks by informal miners in Peru due to the transportation there. There also is disruption at Panama mines, Congo. Chile drought concerns also have led to lower mining and lower grade mining there in sense of copper. That has been supportive. And when you look at the LME stocks as well in sense of copper, they have continued to decline in this year, down by 64% from mid-Feb. So at this point in time, it is a very, very bullish copper prices continuing into the Indian Asian markets right now. Much would depend on what is the follow-up announcement, proposal on sense of tariffs in copper, and that could take the prices higher.
All right. Thank you very much, Manisha, for that. Well, copper is the story, the big story, really, in that sense. We'll take a quick commercial break here. On the other side, it's a special segment. It's the economy. Latha in conversation with Suresh Ganpati of Macquarie Capital on what to expect from a bank and NBFC results in the first quarter. Stay tuned.
Welcome to It's the Economy. Bank loan growth as of mid-June, that is 2025, stood at a mere 9.6% versus 19.1% in the previous June of 2024. So clearly the first quarter bank results are going to reflect lower advances growth, lower loan growth. Separately, the Reserve Bank's giant 100 basis point rate cut in April and in June is going to pull down the bank's margins because loans are linked to the repo rate, not the deposits. Given this backdrop, the market is going into the Q1 results with muted expectations. But who will stand out in the crowd? And is the current muted prices the right time to accumulate bank stocks and NBFC stocks? If yes, which stocks? For all these questions, I'm joined by the finance expert from Macquarie, Suresh Ganapathy is Managing Director and Head of Financial Services Research in that company. Thank you very much, Suresh, for your time. Good morning. Well, like I said, the ecosystem is not very conducive for either loan growth or for margins. But who is likely to stand out of the crowd?
Look, it's going to be bad across the board. The ones which will stand out are going to be, in my opinion, non-banking financial companies because they are not affected much from a margin standpoint going into the quarter, right? But if you look at both PSUs and privates, both of them will end up showing a pretty weak earnings growth or performance because the margins will be down both YOY as well as QOQ. And loan growth will in general be weak, while PSUs may have a slightly better loan growth, but the system level itself being a 9.5% means you're really talking about quite a sluggish loan growth performance. What could happen clearly is PSU banks typically tend to have a slightly higher treasury profits. So in that sense, maybe the quarter is not as bad as one would expect because the treasury profits could save the day. But the beauty here, Lata, here is the markets are, in my view, going by the Nifty bank outperformance in the last 6 months over the overall broader market is overlooking the next 2 quarters because many believe this is just, and including us, this is just a timing impact. The margins will indeed recover over the course of next 12 months. Just the 2-quarter impact and then the margins start recovering post that because the deposit rate cuts have also been pretty aggressive by the banking system.
Okay. One more question before I come to specific banks. What is your sense about end-year credit growth? As you say, the margins may be a U. You'll see it falling, perhaps down even for the second quarter and then start recovering. Perhaps even the exit number for FY26 is going to be as good as the exit number for FY25.
Correct.
But what about loan growth?
Yeah, so this is the area where we are, of course, a bit concerned because, we are at 9.5%. And if I were to really slice the dice and look at the various components of the loan growth, clearly, we believe the triggers are missing. The bulk of the loan book, obviously, is corporate book. And you have seen the amount of equity raising, the promoter sell down, and all kind of cash which has been raised by the corporates. And the corporates continue to deleverage. So that section of the credit growth is missing, or rather, it's not really contributing to the overall credit growth. And even in things like unsecured loans, that the banks have already tightened the filters. Now, they're not going to relax the filters, right? So the filtering criteria will still remain quite stringent. So there would be some modest recovery. So at an overall level, let's put it this way, that we ended FY25 with a 10.5 to 11% kind of a credit growth. No major recovery from that levels. We may be around the same level at about 11%. So I'm not very convinced that the lower rates will spur credit growth. I mean, we have done our analysis in the last 15 years. The correlation between credit growth and interest rates in India is totally non-existent. In fact, it's all over the place, right? So I think there are more than interest rate triggers which is necessary from credit growth recovery standpoint, which is missing at this point in time. So overall credit growth in India is going to be a little bit more muted this FY26.
Okay. If that is the case, then we do have, a problem in terms of top line. But now let me come to the specific numbers. The number that completely stunned me was actually Kotak Bank.
Yeah.
The initial numbers giving 14%, both advances and 14.5% for deposits. So does it mean that we are going to get at least one big surprise in the earnings season?
Okay, so we will have to see how the margins play out. Because see, what's also happened in case of Kotak here is that the ban got lifted in January, right? January, Feb. I can't remember the exact date. So there is an effect of the fact that the full impact of the revocation of the ban could be slowly felt in the April to June quarter from a base effect standpoint, and they could have done better in some of the both retail as well as corporate loan categories. The fact that even the digital 811 banking was lifted means there could be more both secured and unsecured sales done through the digital banking. We don't know. We have to see the finer prints to see the segments which have contributed to this overall growth. So the balance sheet growth for few banks here and there could be better. As I said, at the end of the day, remember Kotak has the highest EBLR portfolio relative to the other banks in the system. So their loans will also get repriced downwards a bit faster. So eventually we will have to see how the margins play out. Clearly, as you know, the margin impact is always going to be higher than the growth impacts. Even if you surprise positively, Lata, 100 or 200 basis points in the loan growth, if margin performance is not satisfactory, then the earnings could be under pressure. And that's what something that everybody will be looking forward. I do believe currently going into the quarter, most bank analysts as well as the market is already factored in a 10 to 15 basis points QOQ margin compression across the board, including Kotak. If the actual margin compression turns out to be lower, it's a positive surprise. If it turns out to be higher, then it's going to be a negative surprise. That's how you should look at going into the quarter.
What's your best guess in terms of who will be least impacted by margin?
NBFCs.
Among the big banks?
NBFCs. Otherwise, everybody is down 10 to 15 basis points QOQ. I mean, we are just looking at marginal. Some will be at 15, some could be at 10, just the timing impact. Cumulatively, the next 2 quarters, you could see 20, 25 basis points. Yeah. Again, the timing could differ from bank to bank, but going into the quarter, 10 to 15 basis points across the board, including PSUs.
Yeah. Actually, even in Q4, I think HDFC sidestepped in terms of margin performance. They were better than the rest. Let me come to the mid-cap banks, because over there are a couple of banks which seem to stand out. One of them is Bank of Maharashtra. I don't know if you have coverage, but that always seems to, they had tax write-backs. They had a few things going for them. And they have reported decent numbers, 14% and 15% loan growth and deposit growth. Likewise, Karur Vysya, again, probably because of the gold factor, that's also been a standout performer. What's your pick of the mid-cap space?
See, amongst the mid-cap banks, the only bank that we cover is clearly a City Union Bank, and we are positive on the name. Valuations are attractive. The ROA is pretty decent at 1.4, 1.5%. And also in case of mid-cap banks, Lata, I think it really depends upon the loan portfolio composition. So, CUBK would be having a lower floating rate composition, and even within that, possibly a lower EBLR composition, because the retail proportion is lower, more it is SMEs, which are a little bit more, the growth is strong. There you can actually have a little bit amount of pricing power, and therefore you'll end up having a slightly better margin outcome. So we do like City Union Bank, but there could be differences between few banks here and there based on the composition of their overall portfolio, whether it is more EBLR linked or not. Yeah.
Fair enough. See, you began by saying that NBFCs will stand out because they're less likely to be impacted. What's the pick of the pack there?
See, the interesting part in the case of NBFCs here is growth guidance. Now, the way we are looking at it is that there is a challenge with respect to the vehicle finance NBFCs in our view. The vehicle finance outlook isn't great. Most people are expecting passenger vehicle sales and truck sales to be around 1 to 2% this year. That's not a very encouraging number at all. So there could be disappointments on growth, right, across the board. Now, so we will have to closely observe what is the growth guidance for the rest of the year. Some are sitting at greater than 20% plus kind of a growth guidance. So I think, the quarter should be okay. Because the full impact of a real slowdown or a lower growth will be felt over the course of next few quarters. The quarter is good for them because the margin performance could be relatively better. So going into the quarter, I will be a little bit more cautious about vehicle finance NBFCs because I do believe from the credit cost angle, things could still be stubbornly high. There is stress in the vehicle finance segment, especially in the NBFC space. Where they could really do better is more in terms of margins. Again, there the housing finance companies, because of a very competitive housing loan book, which tends to reprice faster, they will have a greater degree of margin pressure. So selectively, if I were to slice dice, the two stocks which should stand out going into the quarter could be, in my opinion, AB Capital, Aditya Birla Capital, and to some extent Shriram. Shriram, most numbers should more or less remain flat on a QOQ basis, which is a decent outcome going into the quarter.
Yeah, it has been a good performance from Shriram after the merger. Suresh, what's the word on Innocent? What would you look for? Is the worst behind?
Yeah. So look, we did downgrade the stock to an underperform from outperform about a couple of days ago. And I think our view here is that irrespective of Lata, whoever joins as the new CEO, while there could be a pop-up in the stock price, stock could go up 5-10% on the day the new private sector CEO is announced. The challenges are quite multifold, right? And therefore, what happens in case of IIB here is, as per our analysis and projections, I don't think the stock even crosses the bank, even crosses a double-digit 10% ROE in 3 years' time, right? So our ROE projection for FY28, if I'm not wrong, is 10%. So when you have a bank which is earning return on equity as per our projections, as I said, irrespective of any CEO joining, below the cost of capital or equity at about 12-13%, why would you give it more than one-time price to book? And the stock is already trading at that, right? So clearly, from a fundamental standpoint, we believe the upside in IIB is missing at this point in time.
Okay. It's always not enough time to interview you, Suresh. We will have to postpone the rest of the discussions for another day out of time on Bazaar. Thank you very much for sparing time for us. That's a great conversation. We have to wrap up on Bazaar. Short past is coming up.